Amazon is well on its way to be worth $5 trillion of market cap. That would put it about $500 per share. It's currently at $200 a share. This absolute juggernaut of a cash-generating machine has massive amounts of free cash flow. We're going to take a deep dive into this business. I'm going to unpack the value here, and I want to know what I missed. Why isn't this company worth $500? You let me know. We're going to do a deep dive. You ready? Let's get to work. Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching the channel. I greatly appreciate it. This week up, we're going to take a look at Amazon. It's been a while since we dusted off this stock, which is continuing to march forward. Let's take a look at if we should buy this stock now and hold it. We got some economic uncertainty. Perhaps diving into this stalwart might be something that's worth doing to see how much money it makes. Now, we're going to review this stock like we do at all of the stocks here at the channel with 5 key factors that we dive into to figure out if it warrants further due diligence. Number 1, has to have top-line revenue growth. They should be able to grow their top-line revenue for the last decade. Number 2, earnings. We look at EBITDA, enterprise level, or operating income. You should be able to grow that on an annualized basis over the last 10 years. Number 3, strong free cash flow. Number 4, low debt. We want less than 3 times debt to EBITDA is what we're looking for. And number 5, well priced. What is that? It's basically a conservative forecast that will give you a market beating expected return. That's it. Easy to say, it's hard to do. What we look for are those 5 key factors. I'm going to dive through into this business. If you want to see more, learn more, check out my bio. Also visit us at cashflowinvestingpro.com. All right, here we are. Let's dive into the cash flow club and figure out what Amazon does and how do we unpack it. Very interesting business. The big thing here is kind of revenue distribution. 61% of their revenue is from North America, 22% is international, and Amazon Web Services is about 17% of their total revenue. But Amazon Web Services accounts for the lion's share of their operating income. We'll get there in a little bit. What I really like about Amazon, what I've called out in prior videos about Amazon, is they always put free cash flow front and center. You remember what I've always said, if you watch this channel for a long time, I'm always harping on free cash flow. That is how you value a stock. And that's what every company should put forward as their very first slide. This is how much free cash flow we made, and this is how we calculate cash flow. That's it. Maybe a forecast of it. But if you don't have free cash flow, companies will talk about revenue. If they don't have revenue, they'll talk about customers that they have. If they don't have customers, they'll talk about total addressable markets. That's the kind of order of hierarchy that they will go down to give it you, the investor, to put the money into the stock. Because don't forget, it is the investor like you and I that fund the losses for companies that do not generate free cash flow and that pay the salaries for management and the entire team that's running on that business. You absolutely have to hold them accountable to generate free cash flow. If they are doing stock-based compensation to the excess, they're simply paying themselves, and you, the stockholder, are funding their massive paychecks. Operating free cash flow is calculated right here. Cash flow from operations less capex equals free cash flow. So again, Amazon is saying, hey, front and center, this is how much free cash flow we make, and this is how we calculate free cash flow. We absolutely love that here at the channel. So let's dive into Amazon's revenue here. $637 billion of annual revenue for 2024. That's up from $574 in 2023 and up again from $513 billion in 2022. Rocket growth. I'm shocked at this company's ability to continue to grow top-line revenue at the rate at which they do, given that they're $500 billion of revenue in 2022. I would have thought, okay, single-digit growth, what have you. No, they added $60 billion. That's about a little over 10% annual growth in 2023. And then from that, they added another, $60 billion again on top of that number for the next year. Absolutely incredible. Cost of sales for fulfillment, technology, sales and marketing, and G&A round up the expenses. What I do like to see is G&A, general administrative costs, being flat year over year as revenue scales. That's called operating leverage. Fantastic. And you can see as a result of the operating leverage, operating income grew from $12 billion to $36 billion to $68 billion last year. That is operating leverage. You want to absolutely see that. Now, I want to take a break here and just say for a second that operating leverage is very, very important with a business. I've seen countless businesses, Allbirds, the shoe company is a great one. Another one would be Sweet Greens is another one where the business is scaling dramatically. Revenue is growing. Allbirds, prior to their collapse, this would be true. Revenue is growing, but so is operating expenses. Operating expense is growing just as fast as revenue, so their margins aren't actually expanding as revenue grows. That's the whole point about why growth companies are rewarded, because in theory, as revenue grows and your operating costs remain the same, you get to keep more and more profit. Every extra customer, the majority of that customer becomes profit. Not so if you grow your marketing expense, your SG&A, your legal, your rent, all your other costs. If those scale with revenue, you're not actually making any more money than you used to, even though revenue is higher. So but look out for that. Let's take a look at cash flow quickly. So cash flow is what we like to see at this business. It starts, there's three sections of the cash flow statement, right? Operating, financing, and investing. The operating section is what you make, how you make your cash from running the business day to day. The investing section is what you do with that money in terms of capital and reinvestment. And the financing section is, did you pay a dividend? Did you buy back debt or issue stock? Did you issue debt or buy down debt? That's pretty much what the three sections mean. And here you can see they generated $73 billion of, $59 billion of net income in the period. They had depreciation, some stock-based comp, some various changes to deferred assets and taxes. Here's your working capital change. Most of the drop was other assets. I'd like to see them break that out, actually. That's a little big to be just an other asset bucket. But overall, they made $115 billion of jack, hard, pure money, cash money that they made from running their business for a 12-month period of time. That is outstanding. And what do they do with it? Well, they put $83 billion back into the business by reinvesting it for new growth initiatives or for property, plant, and equipment. And then what do they do with the rest of the money? Well, it looks like they had a little bit of debt back and forth here that they actually bought down and issued, no problem. They paid down $9 billion of long-term debt. Great job. And they paid some leases. So basically, they didn't pay a dividend. They didn't buy any back in stock. That's okay. They generated a lot of free cash flow, and they reinvested it in the business. Good for them. Balance sheet. How do we value business? You want to take a look at the balance sheet. Make sure they have plenty of cash and low debt. That's kind of the idea. And they do. They have over $100 billion of cash money sitting in the bank, clicking away at 3.5% or whatever kind of treasury rate they can get. That is fantastic. That's $3.5 billion a year just in interest money that they're getting. Inventory, current assets, other current assets. Total current assets is $190 billion. PP&E, $250 billion, not bad. Some leases. Goodwill, very small, good for them. Total assets, $624 billion. Accounts payable, accrued expenses, and unearned revenue round out the current liabilities. That's $179 billion. They have $190 billion of current assets. Benjamin Graham will be happy here, right? Your current assets are more than your current liabilities. They do have some debt, long-term lease liabilities and long-term debt. The lease liabilities, that's probably rented warehouse space. It's not quite the same as bank debt. Bank debt would be $52 billion, which they can easily pay off with the amount of money that they make. The net total here is they have $285 billion of stockholder equity, and it grew about $84 billion year over the year. Absolutely outstanding. We've got some charts here that we always drop down when we're looking at stocks. This one's really interesting. If you had bought the Amazon stock when it IPO'd in 97, you held it through the .com ride up and the burst and collapse. There's probably only Jeff Bezos himself is the only one that did this, but good for him, sir. He has generated 250,000% return on that IPO. You want to talk about buy and hold? Most people hold a stock for 3 to 5 years at max. Holding something since 1997 to today, you would have made 250,000% on every dollar you put in. Absolutely incredible. All right, let's go through the cash flow one pager. I'll give you an idea of what we do here at the club and how we look at stocks. This is how I looked at stocks when I was running in investment banking, and now that I'm a CFO for private equity companies, this is how we look at how much we should pay for an acquisition. I'll look at 10 years of revenue, or as much revenue history as they have. In this case, I've got plenty with Amazon. 2015 revenue was $107 billion. And just listen to this growth rate for a second. 107, 135, 177, 232, 280, 386. From 2019 to 2020, revenue grew by $100 billion in a single year. It's a 33% increase in revenue in 1 year. It's just staggering. Then it went to 468, 513, 574, and most recent calendar year, 637. That's an annualized growth rate of 22% over the last decade. Absolute hats off to the team at Amazon for crushing it. EBITDA, earnings before interest, tax, depreciation, and amortization. It is an enterprise level earnings number. You can pick operating income if you choose. I do this because I can get metrics, transaction metrics that are published generally against an EBITDA number. It is a proxy for free cash flow. Admittedly, everybody knows it's a bad one, but it's just what is used in the industry. So I put it here. But we still look at cash flow, don't you worry. 8.5 billion in 2015. 12.3, 15.5, 27.7, 36, 48, 59, 55, 85, 120. $120 billion of EBITDA this company made last year. That is a 34% annual growth rate in EBITDA over the last decade. You'll notice here very quickly, if you're a fan of the show, EBITDA is growing faster than revenue. That means margins are expanding. Congrats, Amazon and the operating team. Debt is $155 billion. That includes, obviously, the lease liabilities. But even then, it's only 1 times EBITDA. Very, very manageable. Market cap and then enterprise value is market cap plus debt less cash. I haven't said this in a while, but enterprise value is the true value of a business, not market cap. What trades in the stock market is the market cap. So what trades in the stock market is the market cap of a business. That's what you see. It's the equity piece, but it's missing the debt that's on the business. So you always want to look at what the enterprise value is of a stock. Most programs will publish the enterprise value, but that's basically market cap plus debt less excess cash. Think of a home. If you were to go buy a home, you're going to pay, look on Zillow, whatever the price is, you pay the market price. That is not the market cap. That is the enterprise value of the house. It's the sale price. If you then wanted to buy it, you could go all cash and buy it all cash, which means market cap equals enterprise value. Or you could say, hey, bank, I don't have all the money. I want a loan. Bank will say, okay, I'll give you a loan. The bank loans you money. You come in with the difference. What you come up with is your equity piece. That is what trades in the stock market. So it misses any debt that's on the business. So you could look at a stock and say, hey, this stock is down in price. It must be cheap, but it might be masked by a tremendous debt burden that's not being shown. So please, always look at enterprise value and always smell check total debt to EBITDA or total debt to free cash flow or interest coverage ratio, some debt metric to give you a feel for is market cap equal to enterprise value? Is there hidden risk as to why the stock might be lower than you think it should be? All right, so then we go to some operating metrics. I like enterprise value to EBITDA. Again, it kind of harkens back to the investment banking days. Not perfect, but it's a proxy. Certainly, if you look at it for a particular company, over time, it is a value metric that you can use. And what this is saying is that the market multiple for Amazon has come down dramatically from a high of 40 in 2017 to 21 times. That seems relative. That seems very cheap to me. at that current price. It's currently even a little cheaper than that, about 20 times, as it trades at $200 a share currently. On the debt metrics, we said this earlier, 1 times debt to EBITDA, that's fine. I want to cover debt for a second. I've talked about this before. I'll say it again. The capital stack of a business, where you sit in the order of bankruptcy, if you were to ever go into bankruptcy court, the equity holder, that's you and I, that buys common stock, we're at the very back end of the line. In front of you, you're going to have you have the preferred stockholders, you'll have the mezzanine debt holders, you'll have the junior debt holders, you'll have the senior secured creditors, you'll have vendors, you'll have fixed asset equipment lenders, and you'll have employees, all sitting in front of you trying to get the assets of the business or any cash to liquidate, to satisfy all those debts before you, the common stockholder, ever see a dime. So when you can find a gem like an Amazon, like a Facebook, like a Google, other companies that we've covered in this channel that generate a lot of free cash flow and have very little debt, so little that, in fact, you, the stockholder, the common stockholder, have bond-like collateral where there's no debt in front of you, so you have that protection of asset protection, but at the same time have equity upside. I think that's a tremendous position to be in as an investor, and it's not something that people talk about when you buy businesses with low debt that make free cash flow. So rounding out this here, we talked about the first section. Now let's get to the meat of the matter, free cash flow. We use adjusted free cash flow where we expense stock-based comp, just to be a little bit more prudent with how we look at the business. But cash flow from operations followed the growth rate of EBITDA here, 28% annual growth rate over the last decade. They had just shy of $94 billion of operating free cash adjusted at the end of 2024. They put $83 billion back into the business, which is a tremendous amount, almost 40% more than they did the prior year. So they're definitely reinvesting in their business to try and maintain the growth level. So a lot of that cash did not come through as free cash. You would expect that money to be used to accelerate growth in the future, or produce cash in the future. They paid down debt, which they really didn't have to, so that this number here is really about $10 billion of free cash flow equity if I add back this debt payment they didn't have to make. Then they've got about 10.7 billion shares outstanding. Shares have been growing over this time. I'd really like to see Amazon buy back some stock. They're focused on growth, which is great, but I'd love to see buy back a little stock. But that puts free cash flow per share about $1 a share, currently at $200 a share. That's a very healthy market multiple of 0.5% on the free cash flow yield. Forecasting this business, okay, we're forecasting this business to grow 19% year over year in EBITDA. The annual growth rate doesn't necessarily matter. It's really the long-term target. If you believe this stock can do anywhere near $300 billion of EBITDA out 10 years from now, you put an 18 market multiple on that, which is low, right? It's currently at 20, 21. You're going to get $500 a share for that stock. You do the same thing on free cash flow basis. It takes $1 to about $8 and change. You give it a 1.7% handle yield multiple, yield, if you will. That gets $500 a share out long term as a guess what could happen in the future. If I put that into kind of an IRR matrix where I have this pro rata share of ownership of cash flow, I can buy as much stock right now as I want for $200. I get $500 out of it. That's a 12% annualized return on your money. That's every year compounding. You're making 12% on your money, owning an absolute Goliath in the AWS space and the retail space, growing double digits, revenue, EBITDA, free cash flow. You have 1 times debt to EBITDA, and that's including all lease liabilities. The actual bank debt was like 60 or 70 billion, so has less than 1 times debt. So your equity position here is actually bolstered by a lot of asset collateral. They have $100 billion in cash on hand. So I think if anyone's going to weather the storm, this business can definitely do so. And if you're concerned about what's going to go on in the future, but you want some exposure to the equities, you might want to consider Amazon as a very interesting investment vehicle for someone who is disciplined long-term holder, right? 10 years or longer. Buy it and gift it to your children. That's how long you should own stock. You were looking for free cash flow. You want something that's got some possible growth. You've got some like a large moat around it. This is very an attractive stock. Take a look at it. Obviously not investment advice. Do your own research. But this is how I like to lay out the stocks that I look at. And it's why I have the Cash Flow Club. It's why I teach courses. If you're interested, check my bio or check out the website. Happy to teach you how to do this on your own. Okay, let's recap Amazon. The 5 key attributes. Number 1, top line revenue growth. Yes, it's there. It's growing at 20% a year. Number 2, EBITDA. Yeah, 30%, 34%. Margins are widening. Strong free cash flow. It's there. They put a lot of the money back in CapEx, so it's a little thinner than I would like, but it's still very strong. Low debt. It's less than 1 when you look at true debt. And number 5, is it well priced? Yeah, at the current stock price of $200, it's expected to beat the stock market, even at an 18 handle out 10 years from now, as long as they can maintain roughly a 9 to 10% annual growth rate in their EBITDA number. They should be able to target roughly $300 billion of EBITDA, which translates to $5 trillion of enterprise value, market cap. And with the 10 billion shares outstanding, it's roughly $500 a share. All right, this has been the review of Amazon stock. Let me know what you think. Happy to take reviews. Throw me a comment down below what you'd like to see. It helps the algorithm. Why not? And check out the Cash Flow one-pager, Cash Flow Club. Grab the one-pagers. We've got a stack of them. We publish them all the time. Print them out, save them, and then as the stock market fluctuates, you have kind of like a guide. I would recommend that you have maybe 30 stocks that you would absolutely love to buy at the right price that you know very well, and you sit back and wait for the market to deliver you a gem. Facebook did that about a couple years ago when it was trading at $70 a share, and we did a review of the stock, call it a buy, call it an amazing buy actually. It's up tenfold in the last 2-3 years. That was a huge win for the channel. But we spotted it here. Check out, subscribe. Happy to take your comments. My name is Cameron Stewart, CFA. Run a channel as a hobby, and appreciate the support. Take care. Bye-bye.